Hey everybody, I'm Sean Ryan, partner and co-founder of R2 Accounting, and this is R2 Cents. On R2 Cents, the purpose is to get information and experiences out to small and medium-sized business owners that we've seen, and we'll also tap into some of those information and experiences that our customers and peers have seen as well. If you find this helpful, please like and subscribe below, and feel free to leave comments in the comments section as well. With that said, let's get started. Okay everybody, thanks again for being here. Today we're going to move into part 3 of our 4-part series on understanding the financial health of your business. So as we've talked to in some other sessions, this is really made up of 3 pillars. The first is the importance of quality bookkeeping, and the second is the importance of operational and financial results analysis. Now, if you haven't watched these yet, I'd encourage you to go back. They're great precursors to today. Which is the third pillar, the importance of cash flow forecasting. Now, pretty much all large companies are doing this, and we typically find the smaller a company gets, the less likely they are to be doing cash flow forecasting. Or, maybe they are doing it, but they're just not doing it properly, and we'll get into what I mean by properly. But really today's focus is, why is it important to be doing this if a company of any size, and how do we do that properly so that we're getting the most bang for our buck? Okay, so when we talk about cash flow forecasting and its importance and how to do it properly, I want to discuss this in a framework of the benefits of forecasting. And I think by going through those benefits, it's really going to sort of illustrate and drive home how to do it properly and what results you can achieve by doing that. So the first benefit I want to talk about is understanding what drives cash flows. Now, we talked about this a little bit in the context of operational and financial analysis, looking at those past results, understanding what drivers go into our revenues and expenses, and analyzing those gives us a good idea for what they are in the context of the past. But if we want to take that a step further and move into cash flow forecasting, what we're really doing is we're taking that and setting an expectation for what we should be seeing for those figures into the future. So if we look at our trend analysis and we can understand in the past what our revenues, our costs are, and we're saying, well, I think reasonably we would expect to see similar or other results in the future based on certain assumptions. If we're not realizing those estimates, if we're not seeing what we expect, it allows us to ask why. We might have an understanding of what's going on looking at the past, but there must be something else impacting these numbers that we're not aware of, and it really lets us dive into additional detail, get a little more understanding than what we had before. As an example, on the revenue side, let's say we have an equipment sales business. Our sales team is probably really driving sales. We know what our price is. We maybe even know what our direct costs are, whether we're a reseller, we're buying and selling, or maybe we're manufacturing it ourselves. Either way, if the sales team is responsible for driving those sales, what can our sales team sell in terms of quantity? And really, what should they be selling? If we can lay those expectations down, it lets us have an understanding of, is the sales team maybe not performing, or are our expectations just too high? Maybe it goes the other way and we have an expectation that they're going to sell X, but they actually exceed that. And we realize something we never known before, and it actually just leads us to change our expectations. On the cost side, we talked about direct costs briefly, but you also have other costs like general and administrative costs, wages. There could be a lot of cyclical costs in there that are month to month, and they might be easy to forecast out. But you might also have one-time costs as well. Let's say even just something simple like looking a month into the future. If you think your bank balance, cash, is going to be, $2,000 at the end of next month, but you have a one-time cost that comes through, say your insurance costs for the year. They get paid once a year, if that's how you do it. And say the insurance company tries to automatically draw that amount, now your bank is in an overdraft. That's a problem. Being able to see some of these, learning that lesson, and then forecasting them to the next year, it really just gives you that extra level of understanding. So now, whether we're meeting forecast targets or not, it really doesn't matter. Understanding those cost and revenue drivers is really going to help extend our knowledge of the business over and above what we can get through operational and financial report analysis. So the next benefit I want to talk about is gaining predictability over cash flows and resources. Cash flow forecasting isn't something that's meant to be done once and then never looked at again. The more regularly that you do this, the better you're going to get at it. A lot of entities do this annually. If you do this quarterly or even monthly, you're going to be so much better at it. I obviously do it monthly, and I'm a huge believer in monthly cash flow forecasting. What it's really going to let you do is, if you're taking your actual results and comparing those to forecasted expectations every month, you're going to get a great understanding every month of, were these assumptions valid, or what do we need to change? What expectations do we need to change, or what strategies do we need to employ to get the results to where we want them to be based on our expectations? Doing that monthly, if you're seeing big variances from your expectations, 3 or 4 months in a row, that's a pretty high indicator that something's not right there. It also adds to our ability to look out into the future further. The more and more you do this, the further out you're going to be able to forecast. And this isn't just even really cash flows. We might be talking about cash or debt balances here. Imagine doing monthly forecast modeling and being able to tell, what my cash balance might be every month for the next 6 months, and doing it so regularly that you get to a point where you can actually reasonably estimate your cash balance 12 months from now. That level of visibility and that level of predictability it goes a long way to understanding your business. But not only that, if you're a business owner, it adds actually invaluable to letting you sleep at night. The next benefit that cash flow forecasting has is preparing for bumps in the road. Your business is always changing, and so is its environment. New competitors or products can enter, new regulatory requirements, laws could come into place, or maybe most notably, a pandemic could hit. What cash flow forecasting does is it's allowing you to look at your business and not just plan for growth, but we need to plan for a rainy day as well. If a new product enters the market, and as a result, for whatever reason, we decide we need to cut our product sale price by 20%, what's that going to do to our monthly cash flows and our ability to earn going forward? Maybe reducing it by that 20% takes us from a profit position into realizing losses every month. If that's the case, that's a problem. We need to kind of figure out a strategy to employ to get back to profitability, whether it be cost cutting or maybe increasing value to our existing profits so we can raise that price back up. But if we're seeing consistent losses, a cash flow forecast will also let you know when those losses are going to pile up and when do we get to a point where we may run out of cash. Now, if that point is sooner than we can employ our recovery strategy, we may need to make a decision to look for external funding. Now, maybe the business owner or shareholders could put in additional funds, but maybe we need to go to the bank for financing or find a third party. I mean, those are big things to do, but they require time to carry out. And having that knowledge beforehand, before the competitor or the disaster even hits, is going to go a long way to help your preparedness. Cash flow models, we mostly think they're mostly about growth. Our business strategy is about growing our business. But we also need to be thinking about the rainy day. What is our strategy if we need to do damage control, and how are we going to get out of that? The next benefit of cash flow forecasting that I want to talk about is preparing for financing requirements. At any point in a business's life cycle, there could be the need for external financing. Could be the reason we just previously talked about, to cover operating costs in a period of short-term cash shortfalls. It could be that the company is seeing some really early success and needs that funding to grow quicker than they would be able to normally. When this happens, the investor or a potential purchaser is going to want to do a due diligence process where they come and look at all the data associated with the business. And part of that is cash flow modeling. Now, they may run their own models based on the information they see on the data you provide, but they'll certainly want to see what your forecasts are. And being able to have this cash flow forecast ready immediately does a few things. First of all, it can expedite the process. They'll get through it much quicker. It also shows that management's committed to having a good or a solid understanding of their business and making informed decisions as a result. And it also adds to your credibility. Any business owner or management team that has a cash flow forecast that they can just provide at the ready really speaks to their commitment and their striving for quality. If you get a potential purchaser come in and asks for information, a cash flow forecast, and you don't have it and you need to provide it, typically what will happen is you're now in the situation where you've got to provide one and one that's meaningful and understandable, but in a short amount of time. And inherently what will happen is you're probably going to be left with the result of a poor quality product. And when you do that, it really could impact your ability to find that financing or to close the sale. Having that cash flow forecast ready as part of that due diligence process really is invaluable, and it just saves a lot of stress and time on your side as well. So the last benefit I want to talk about today is measuring the value of your business. Selling or not, it's always beneficial for a business owner to have an idea of what their business could be worth. And to take a step back here, I want to be very clear. Business valuation is extremely complex. It is an art in itself, and there are professional designations associated with it. So I don't want to take anything away from the business valuation experts out there. But what I do want to say is a really good cash flow model will give you a good high-level base for where to start a detailed business valuation. But it will give you an idea of where the value of your business is at a very high level. So there are many reasons for a purchaser to want to buy a business, but the reality is, if they're looking to buy a business, they're taking the business and all the risk that's associated with it. And really what they're doing is they're making an investment, and they just want some comfort that they're going to get a return on that investment. So, in its simplest form possible, they just really want some comfort over the stability of the existing cash flows, but also what is the potential for growth for the future cash flows. If they're going to take on this risk, what is the possibility and what is the range of return that they might be able to realize? Also for the current business owner, when you have that idea of what it's worth right now, the business that is, you might not be thinking currently about selling your business, but it will get you thinking about, what's the price that I'd be willing to take to part with it. You might really enjoy what you're doing. You might love it, and the thoughts never crossed your mind. But if you have no idea what it's worth, you might start thinking about maybe selling it when you may had not thought about that before. But at least being armed with that information keeps all possibilities open. And allows you to really think into the future and realize what you want to get out of this. So as always, if you're not doing cash flow forecasting right now, when is the best time to start? It's now. If you start to run some cash flow modeling and you realize that your company may run out of cash in 7 months from now, wouldn't you rather know that now as opposed to 1 month before it's going to happen? We've talked about how cash flow modeling can give us insight into whether we're profitable or not, what are our cash flows, but also what are our cash and debt balances. That's all great information to arm yourself with. But the most important takeaway actually from this isn't related to the modeling itself. If we create a year-long budget for next year and determine we're going to show 30% growth for this company, the most important part of this is developing a strategy and picking specific action items that we're going to carry out in order to make sure that happens. Creating the models is great, but if we're not committed to carrying those out, we're not going to achieve our goals. Conversely, if we see that we're going into a problem area, a danger area, and how we need to recover from, what specific strategies and action points are we going to employ to come out of that? If we're not committed to it, the whole process of going through cash flow forecasting is really nothing more than providing you data. So I urge you to think about that when you consider making this part of the regular financial plan for your business. If you need help getting started or want some advice, we're always here to help. Please don't hesitate to contact us. Hey, thanks again for tuning in, everybody. If you found this useful, leave a comment in the comment section below. And as always, like and subscribe to get updates on future content. If you want to reach out to us directly, you can do that at info at r2accounting.com, or feel free to check out our website, r2accounting.com. Again, I'm Sean Ryan, and thanks for watching R2 Cents with R2 Accounting.